Ladies and gentlemen, welcome back to the channel. Wow, do we have a lot to cover here in today's video. Comments from Besson, Trump, Wolf Research, Bank of America, all kinds of different things. But let me just tell you at the start of this video, what you are seeing today and yesterday, specifically in small cap stocks, is a short squeeze. And we'll break down why that is and what could be coming next for market. So we have a lot to get into here in this video. Hit that like button, subscribe to the channel if you have not done so already. Check out that link down below in the description of this video for the trading community. If you want to come invest in small cap AI stocks that are really undiscovered by Wall Street by any metric, for those outsized return potentials. Nothing is guaranteed, obviously, but we're really going for 10, 20, 30x opportunities. Check out that link down below in the description of this video. With that said, on to today's episode. Now let's get into your broader market news today and why the Russell is outperforming so much relative to the S&P and your other indexes. Because, I mean, the Russell right now is up 1.4%. Yesterday, you were up almost 3%. This is like a 4.5% move in the last 2 days. So what's going on? And honestly, I think most of this outperformance today has to do with really two things. Yesterday, we had CPI that came out, largely in line with expectations, okay? It actually came in, so for core month over month, we came in at 0.32%. The average median estimate on Wall Street was 0.31%. But I think that was better than what Wall Street was actually priced for. I think Wall Street was priced for like 0.35%, because even if you're in the camp of like tariffs will cause a one-time price increase, you were probably expecting larger than 0.32%. I'll say that right from the start. But this was the first month where pretty much everyone thought that you were going to see some kind of tariff inflation. Now, I didn't, because I don't think tariffs are inflationary, but pretty much everyone on Wall Street expected to get this tariff inflation. Well, wait, we still had inflation, but it came from services. Specifically, a lot of it came from housing. So if you strip out the housing numbers, which are kind of its own can of worms to begin with, okay, you really didn't have any inflation. And that is great for small caps, right? Because if we're not seeing tariff inflation and we're seeing very little inflation minus housing, you really don't have an inflation problem. So at this point, it's pretty safe to say we're not seeing tariff inflation. Theoretically, could we? Wall Street's still going to have those doubts that next month we could get that tariff inflation. Okay, there's always going to be a little bit of that fear lingering. But you did not see inflation in goods the way that most people were expecting. And this really boosted the odds of Fed rate cuts. Now, Fed rate cuts can be bullish or they can be bearish. If the Fed is cutting because we don't have an inflation problem, that is bullish. If the Fed is cutting rates because the economy is weakening, that is not good. But there's the offset to this. Because if the Fed is able to cut rates before the economy weakens or perceived to weaken, then it lowers the odds of the economy weakening. The faster you get rate cuts, the more accommodation, in theory, you can have in the economy, the less the chance is of a recession. Now, what areas do better or worse during a recession? Is the NASDAQ going to do better than the Russell during a recession? Absolutely, right? The Russell's going to be the underperforming index. So with no tariff inflation and Fed rate cuts, that directly benefits the Russell the most because interest rate sensitive, smaller cap companies, higher beta companies, right? More susceptible to needing to raise capital, right? So interest rate cuts just by themselves, positive for the Russell. But also getting these cuts lowers the odds of a recession, which the Russell is most, negatively impacted from to begin with. Okay. So that is why the Russell is going up. And I do think, again, from the election highs, like even after the 4.5% rally we've seen, the Russell is still down about 5.5% from all-time highs. Whereas the S&P is from that same period, right after the election, in February, call it, the high on the S&P prior around, the S&P is up 5.5%, almost 6% from that same period. So really, the Russell is underperforming like 12% still following, the last 2 days of a rally relative to the S&P. There's a lot of potential catch-up that needs to be done within small caps. And that is partially the explosive move that you've seen in the last 2 days. What you're also seeing here is a short squeeze. Okay? You're seeing a short squeeze on the Russell. Because what were the computers doing? The computers, which account for about 80% of trading volumes on any given day, were saying, okay, look, if the economy weakens from tariffs, that hurts the Russell. If inflation rises because of tariffs and we don't get cuts, that hurts the Russell. So let's short the Russell, go long AI, go long, mega caps, right? That has been the trade for a while. Okay? It's short small caps, go long S&P, which has worked very well. Okay? Well, now, given the inflation numbers, maybe that's not going to continue to work. And from an algorithmic perspective, you are seeing a fair bit of shorts covering. So I think that is part of this as well. And some of the most heavily shorted stocks are the ones seeing the largest boost. Like I get asked all the time, like one particular stock, we own in the trading community, like it kind of does its own thing, right? It's only about 7% short. This is the stock I have $80,000 in. It's only 7% short. So it kind of does its own thing. Okay? Because it didn't have a large short position on it to begin with. So that stock's actually down 2% today. Okay? But that means nothing because it wasn't a heavily shorted stock. Whereas you have Bitmine, that was a heavily shorted stock. Well, going up 12% today. Okay? Biopharmas, gene editing names, CRISPR, and some of the other ones that we invest in that group are 30% short. So of course they're up 5 to 10% today when the Russell's going through a short squeeze. Okay, so it is kind of company specific where to me it doesn't look like euphoria the last 2 days in small caps. It looks like a more systematic, shorts covering, algorithmic, covering kind of behaviors. Now, here's the interesting part. I do think we're going to get a lot more euphoric in the last 2.5 months of this year. From mid-October through November and December, that is when I think we're going to see the largest rally. Because at that point, it's going to be clear. We're going to get a bunch of Fed rate cuts. By then, we're going to have likely 2 rate cuts already the markets are pricing in. We're probably going to be pricing in many more for, next year. I think the economy is going to be in a good place. Consumer recovering a bit. AI and CapEx are going to be booming better than ever with likely more use cases coming online next year. Okay. Big, beautiful bill, very stimulative from a deficit perspective, from, the 100% 100% depreciation on capital investments versus 40% in prior years. No tax on tips, no tax on overtime. There's a lot to be excited about just in that alone. Okay. So I put all of this together. Trade deals should be pretty much done or nearly done by then. Hopefully geopolitical conflicts have died down. War in Ukraine, hopefully over with at that point. There's a lot working in the market's favor into the end of this year. Seasonally speaking, September is going to be a toss-up. It might be good, it might be bad. If it is bad or not great, I think that is an opportunity to prepare for the year-end rally that at this point looks inevitable. We do have some other news today, a lot of Trump comments, so let's get into those now. Trump says DC will be a beacon for other cities after crime crackdown, says he'll likely ask to extend authority over local cops. Now, again, just let's be clear, we did not have much for economic data today. A couple Fed speakers, and we'll get into that in just a moment. Tomorrow on Thursday, we get PPI month over month, initial jobless claims, more Fed speakers again, but Friday's the big day with retail sales month over month, and the expectations are not super high. It's 0.5%. The previous month was 0.6%. New York Empire State Manufacturing Index, export prices, import prices month over month, and Michigan consumer sentiment. Michigan consumer sentiment is also very much like we have negative expectations. We're not expecting positive news here. Same kind of with retail sales. We're not expecting anything too bad for retail sales, but we're not expecting anything good. And when you have low expectations heading into economic data, the odds are skewed in your favor if you're a bull. If you're expecting, better than expected economic data. Okay, so keep that in mind. Finland's President Stubb says Trump said he would focus on achieving ceasefire at the Alaska meeting. Finland's President Stubb says one of the key signals from Trump today was that territories would not be discussed in the Alaska meeting. Trump says there will be, quote, very severe consequences if Putin doesn't agree to stop the war after Friday's summit. Trump on the Fed says he will name a new chairman early. So how early is this going to be? I don't know. Probably by the end of this year. And, that could further help add to the bull thesis and the rally that we get in markets. Now, here on the day today, the odds of a September 17th cut are 99.4% following Fed officials today. Again, that's why the Russell is going up. People were not betting for this. A lot of even major banks had the view of either no cuts this year or one cut this year, and they were not expecting September 17th. So the algorithms were shorting small caps, going long, Mag 7, if you will, and now all of that is flip-flopped. Literally just yesterday, there was a 91.4% chance of a September 17th cut, an 8.6% chance of no cut in September. Now, there's only a 0.6% chance of no cut in September. Like, the odds are massively flip-flopped. October 29th, 68.2% chance of a Fed cut October 29th. So you're pricing in a cut September and October. And now for December, you're pricing in a 55.9% chance of a third cut. So you're technically pricing in 3 rate cuts throughout the rest of this year. You're pricing in a pause for January 26th. Okay. For March 18, 2026, you're pricing in another cut at 38.6%. Let's see. You're pricing in a pause for April. For June 17th, you're pricing in a pause, but it's pretty close between a pause and a cut, June 17, 2026. July 29th, you're pricing in another cut. September 16th, you're pricing in a pause. October 28th, you're pricing in a continued pause, and December 9th, you're pricing in a continued pause. So you're pricing in a couple of additional rate cuts next year. But again, as the inflation data shows, we're not having an inflation problem. Like, you could probably price in 2 to 3 more rate cuts for next year than what we're pricing in currently. And that could continue to fuel that AI, that risk on area of our markets into the end of this year, and well into 2026. Trump on a Fed chair says it is down to 3 or 4 names. Trump says interest rates should be 3 to 4 points lower and will name a new Fed chair early, again down to 3 to 4 candidates. Trump on interest rates says it's really just a paper calculation. Trump's call with Europeans discussed a possible location for a meeting between Zelensky, Trump, and Putin after the Alaska summit, according to a source familiar with the matter. Trump says second Putin-Zelensky meeting depends on the first, warns Russia of consequences if conflict does not end. Trump says, I would like to do a second meeting with Putin almost immediately. There may be no second meeting. And again, this is another big risk to markets. If Putin does not want to end the war, if Putin is the one that is holding things up, which I don't think is going to be the case, then Trump is going to put on secondary tariffs on other countries and basically choke off Russia from selling their oil globally. Okay, nobody's going to choose to do business with Russia over the US. Like that's just not going to happen. Okay. If Zelensky is the one that holds it up, if anyone does hold it up, then that's okay. That's fine for markets, because then Trump's not going to put additional tariffs on China or on India or other countries that are doing business with Russia. Trump says it was not his call to leave Zelensky out of the meeting. Trump says that he wants a long-term extension of the control on DC. Trump, on a report of Russian hacking, says I could bring this up with Putin. And Trump says he will be asking Congress for money to repair DC. And according to Bloomberg, financial anxiety is rising. Trump told European leaders and Zelensky that ceding territory will be necessary. Bullard says the president is free to give his views on monetary policy. Now, what's interesting is Bullard was the guy in 2022, if you guys remember, that would give a speech and markets would tank. He would say interest rates might need to go to 6, 7, or 10%, and stocks would just absolutely tank following that. Well, he stepped down from the Fed after his tenure. I believe that was 2023 or early 2024 maybe. And yeah, we haven't heard much from Bullard these days. Bullard says if he were the chair, he would try to end groupthink. U.S. Treasury Secretary Bessent floats rolling out export tax to more industries. Bank of America's CEO Moynihan says economists predict no Fed rate cuts as inflation gradually decreases. So again, that's just part of what's happening to the Russell today. Everyone on Wall Street was expecting inflation to rise. Again, like 70+% of investors on Wall Street are Democrats. Like they were expecting inflation. The Michigan Consumer Sentiment Survey, where inflation expectations have skyrocketed, again, that was Democrats. It's very political. And when people are investing their money in a political way, you get these dichotomies where small caps are shorted to oblivion, okay? And then they're wrong, because tariffs were never going to cause inflation to begin with. Tariffs are a tax. A tax will never, ever cause inflation. The only thing that causes inflation is money supply, okay, and excess use of debt, okay, which you can make an argument that we're still doing the same crap, but the money supply is not rising at a pace in which we would have a dramatic inflation problem, okay? Long story short, this market is very political. Not just the Fed. And the faster people realize this, the more money you can make from it. And I think this is a tailwind to small caps and risk on areas for a while to come, because Wall Street's going to be surprised that the next report doesn't show inflation. Okay. And the next report, and that we actually start to get Fed cuts and we don't have a recession. Okay. Now, this also goes for the bond market as well, okay? So bonds have an inverse correlation to yields, okay? So if bond yields are going up, that means investors are selling bonds. If bond yields are going down, that means investors are buying bonds. Investors were shorting bonds, driving yields up because they were expecting higher inflation, less cuts from the Fed. Well, now following the CPI report, you've seen bonds come down. 10-year Treasury yields are down 6 basis points today. That actually means people are going out and buying the bonds. They're covering some of those short positions on the bond market. Again, just further kind of proves the point that I'm making here. France's President Macron says Trump said he wanted to obtain a ceasefire in Ukraine during the meeting with Putin. Norway's finance minister says Norway and U.S. talks about tariffs are continuing. Switzerland says the U.S. refused fixed cost contract on F-35A jets. Switzerland won't cancel the F-35 order even with the fixed price. Bessent sees a strong chance of a big September rate cut. Treasury Secretary Scott Bessent said there's a strong likelihood the Federal Reserve will cut interest rates by 0.5 percentage points next month. He noted that sharp downward revisions to non-farm payrolls suggest the Fed could have lowered rates in its last 2 meetings. That tells me there's a very good chance of a 50 basis point cut, Bessent told Bloomberg TV, adding he's hopeful for the September meeting. Wolf Research says that earnings are strong and valuations are back at, quote, nosebleed levels. Saying with Q2 2025 nearly complete, Wolf Research says results have been very solid. Of 452 S&P 500 companies reporting, 69% beat revenue estimates, 2.8% surprise, and 80% beat earnings forecast, 8.4% surprise. Despite volatile U.S. tariff monetary policy, nearly half gave Q3 guidance above expectations. Valuations have surged, with the S&P 500 trading at 22.3x forward earnings, near all-time highs. Wolf sees seasonal volatility ahead, but says fundamentals remain strong, supported by trends like AI-driven spending. Again, that's why I agree with this. Could valuations go up a little bit more? Could we go to like 24 times, 25 times, potentially? Sure. Anything's possible. But I think the outsized returns, they're not going to come from the S&P. They're going to come from those smaller cap areas, the areas that are trading at, steep discounts to their historical averages, like small caps, specifically AI small caps that are really underlooked and underappreciated right now, I think pose some very unique opportunities. Come join the trading community if you would like to get involved in these opportunities. Link down below in the description of this video. Also in the news today, Bessent asked about 200% secondary sanctions on China. And he says everybody at the G7 was quiet when I asked. Bessent on 30-year bonds says we are committed to keeping inflation expectations low. Bessent says we should be 150 or 175 basis points lower on the Fed's rate right now. And Bessent says the Fed funds rates are constrictive. So let me know your thoughts on all of this down below in the comments section. You're definitely seeing an interesting market dynamic starting to unfold. And to me, it just looks like a bit of a short squeeze. But honestly, I think it is bullish for the S&P as well. I think just the stretched positioning and shorting of small caps was a little egregious to begin with. So you're getting that snapback today. But ladies and gentlemen, with that said, hit that like button and subscribe to the channel. Check out that link down below in the description of this video for the trading community. Have a great rest of your day, and I will see you in the next one.